All right. Hello, everybody. Welcome back. And thanks for joining us again. If you got my little notification the other day, you will have noticed that today we have my favorite lender, Natalie, who I always recommend. Natalie Lenderman is her name, ironically enough. But let me bring her up here. Hey, Natalie, how's it going?
Hey, Will. I'm good. How are you?
I'm doing well. So I was just talking to Natalie off camera a little bit about what I wanted to discuss because it's finally getting to the point where people are starting to come down in their prices and we're getting more things on the market. And it's finally a good time to buy. Obviously, the interest rates are much higher than they have been. Um, but yeah, I guess why don't we start out by you can just tell us a little bit about yourself, how long you've been doing it, and
Yeah,
then we'll get into the nitty gritty once more people hop on here.
absolutely. So I'm Natalie Lenderman, and I've been in mortgage for the last 17 years, primarily in Montana, but I'm licensed in 20 different states. And I would say that my specialty is just individualizing the loan for the client. It's not a one size fits all. So I take a little more time up front, asking a lot of questions to make sure that I'm placing them responsibly in the right long term debt.
Yeah, and those of you that have been on this feed before and have talked to me before, like I said, I always send you Natalie's way when we get into the financing into things because she's awesome and she knows she's forgotten more than I know about the financing end of things, but that's her job. So, well, before we get into the loan part of the show and your part of the show, I don't know if you're aware of this or not, Natalie, but one of the things I've started doing lately is we put up the local police report. So
Oh,
some of these might be calls that you made.
oh,
Um, I'm not sure. But anyway, here's the police report for this week. We'll start out with this one here. A man clad only in his underwear stopped into a gas station for a snack. So that had to be a interesting day at the gas station. And several dogs were running laps around a no dog sign. So those are very bad dogs.
sounds like a Karen.
Yeah. And this is a good one. Someone told 911 dispatch they'd just been assaulted outside of a bar, but multiple witnesses told a responding officer that the man had just tripped over a bench. Sounds like the man had had a few too many beers that night. At 1:30 a.m., a caller described a crazy light in the sky that looked like a spotlight hovering in place for hours, but it was definitely not the moon. Sounds like she may have been having beers with the guy that tripped over the bench. A man kept snacking on produce while wandering through the grocery store. I mean, this all could be the same guy. I don't know.
Hmm.
Um, a cow was mooing a lot. That's an interesting reason to call the police. A caller complained that the nearby rodeo was bumping the bass too loudly. Well, that had to be over in Columbia Falls. Or actually, these are from August, so that may have been the Kalispell Fair too. A boy got upset at his mother and threatened to put a hole in the wall after he found out he was only earning $1 per chore, which made it difficult to save up for a video game.
Hmm.
Classic. Someone reported their neighbor for mowing the lawn in the middle of the afternoon. That would be a Karen right there.
Huh.
Kids were spinning Brodies in a parking lot. I think we've had that one before. That must be the same caller. And then finally, we have someone tried to deposit several $100 bills at the bank that clearly had studio money printed on them. So that was a good effort, I guess, on their part, but they weren't able to sneak it by. So I guess that leads us into you and the financing part of things. Um, good.
Studio money doesn't work for lending.
Can't use that as a down payment.
No, nope. Although I have had clients ask before if they could bring like a briefcase of cash, and that is a negative as well.
I was
Yeah.
just talking, I was at a closing not too long ago, and I was talking to the title company, and I don't know how that came up, but the briefcase full of cash thing, they were saying that a guy wanted that for his, instead of they normally just deposit your money into your account or whatever you tell them to do. He wanted it in cash, and they did it, which was kind of weird, but
Yeah.
or they sent him to the bank to do it, but yeah, kind of an odd request. Apparently, he needed to make a purchase after he sold his house.
Okay.
So, anyway, so the reason I brought Natalie on here today was I wanted to talk to her a little bit about the strategies for buying right now. Obviously, the interest rates are high, and that's, creating what we're having now. This is the first time in 3 years, 4 years maybe, that you can actually, there's houses on the market and people are, there's not 10 offers on things. People are actually negotiating now with sellers. So there's a few different programs that Natalie can talk about here, or strategies, or I don't know if you want to start with the 2-to-1 buy down thing, but
Yeah, that's probably the hottest one that's been out there for a little over a year. It's also known as date the rate, marry the house, but date the rate. And it's a pretty unique scenario. So, just as a disclaimer, we do qualify you with that long term fixed rate. So, you are still getting a 30-year fix or a 15-year fix, whatever that product is that you're selecting, you're still getting that fixed term. But what happens is you negotiate with the seller upfront for a seller credit. And that credit is calculated to buy down your rate for the first 2 years of your mortgage. And it supplements the payment by the percentage that you're saving. So, for example, if we locked in a client today on a 30-year fix at 6.875, the first year of that mortgage, they're going to pay 4.875. The second year, they're going to pay 5.875. So how that's calculated is the money that the savings is set aside in kind of like a savings / escrow account, and it supplements every payment. Then that third year is when it adjusts to the 30-year fixed note rate of 6.875. So I ran some quick numbers just to make it a little more relative. So on a loan amount of $450,000, which is a pretty average size loan amount for this area, if we were to lock in at 6.875, the first year, every month, they would be saving $575 a month in interest. And then the second year, that payment is $294 less a month. So instead of getting, let's say, a seller credit towards prepaids and closing costs, this money is set aside to supplement the monthly mortgage payment so that the consumer is paying a subsidized rate.
So, all right. So you said the rate right now is 6.8, you said?
Yeah, give or
Right.
take, depending on qualifications of credit score, type of property, occupancy, all the things. And so the coolest feature that I like about this is, let's say rates go down next year and the client wants to refinance, which of course makes sense, right? The money that hasn't been used actually goes towards the payoff of the loan. So they're never going to lose out on the money that they negotiated with the seller. And I like that feature because if you do a permanent buy down, so that is the cost to buy down the rate for the full 30-year fixed mortgage, and you refinance in a year, you never see that money back. it's not refundable. It's just your hope of buying down the rate to be in that long term. And so that goes back to making sure that you're having these strategy conversations with the lender to really make sense of what is it that works best for you. Is this a forever home? Is this, let's get you in, let's save some money and then refinance you down the road? Obviously, we can't predict what rates are going to do, but of course, everyone is anticipating that they're going to go down in the next 12 to 18 months.
But if they go up even more, you're still locked in at the 6.8.
Yep.
So it seemed, I know that Natalie had told me earlier that off camera that, I don't know, you're not a huge fan of these, or?
Yeah, I'm not a huge fan of it. Again, it's not a one size fits all, right? The reason for that is typically consumers like to spend money and they forget that their payment's going to go up. And so, when the car breaks down, they go buy a new car and now their car payment's got, increased. And so I personally just don't like payments adjusting that high, especially on a mortgage, right? It's a lot harder to sell a house than a car. And so it's a long-term asset. It's built for a long-term asset. And that's where I have mixed emotions about it. And again, it just depends on the client. Does it make sense for this client? Is this person more responsible and have plenty of cash flow and they've got a lower debt to income ratio and they can afford it? That's my biggest hang up with it.
So, but like, if you don't want to do that, is it like, is the rate lower than 6.8, or that's the rate?
You can always buy down the rate. I tell people you can buy the rate to whatever you want, but does it make sense? So for example, does it make sense to buy down the rate permanently upfront? So it's an upfront cost with your closing costs. Let's say it's 0.5%. So you want 6.375 versus 6.875. Depending on the day and depending on the pricing, it may cost $15,000 to do that on a loan amount of $450,000. And that's where we have to consider, are you going to be in a position to refinance down the road? And if so, then maybe not spending all that money up front makes sense. Or maybe it's someone that qualifies now, but is going to start a business next year, and they might not qualify when rates come down. Then maybe that makes sense to spend that amount of money to buy down the rate. But it's not a straight calculation of 1%. 1% of the loan amount is going to get you, 0.5% savings on the rate. It doesn't unfortunately work like that.
So maybe I didn't hear you, or I don't remember, but if on the 2-to-1 buy down thing, so how much money do you have to put down to do that?
So there isn't a down payment requirement. These buy down options are on most of our products. So FHA, government financing, conventional financing. There are some limitations, like you can't use a buy down on an investment property, unfortunately. So if you're buying investment property, any seller credits are going to be towards a permanent buy down or your prepaids and closing costs. Another example of when it's not eligible is a manufactured home. So it's really program specific, and the amount has to be calculated, as you're negotiating, or maybe after you've gone under contract and we're negotiating for seller credits. The example that I gave earlier, the 2-1 buy down on $450,000, that calculation that would need to be negotiated with the seller is just under $10,500. And like I said, that's straight up the buyer's money. It goes into, that escrow account to supplement that payment. And let's say only 2,000 of it was used before rates go down. Awesome. The remainder 8,000 is going to come off of the actual payoff when you refinance. So you're not actually losing any money.
Gotcha. Well, yeah, I don't know. I mean, I get your point about if you're not careful, the rates are going to, or, the payments are going to go up automatically in a year. And, but if you're disciplined and you just plan
Yeah.
on, because if you didn't do this, you'd be making the higher payment right out of the gate.
Exactly. Exactly. If there's one thing that's true about your mortgage payment is your property taxes are either going to stay the same or go up. So I always try to, coach consumers of make sure you just set a little bit more aside every month. And then when your tax bill comes out, or let's say you had an insurance claim and your insurance went up, those are the two things that can change in a fixed rate mortgage payment. We say that that's the payment, but those are the two variables that could change through the life of the loan.
Gotcha. So does this, we have a lot of people on here from other states that
Yeah.
watch, and is this a national rule or is this just a Montana thing?
Yeah, no, this is eligible for all of the states that we lend in. So it's a Fannie Mae, Freddie Mac program that was released at some point last year. And like I said, that slogan of date the rate, marry the home. So get the home now and pay a lower rate until, rates come down, which of course we all were hoping that the spring of 2023 was going to show some favorable rates, but they never did. And they've actually gone up. So, that's the thing is we can't predict the future. These are just tools to help consumers get into a home, especially now with sellers being able to negotiate, try to get every penny you can. There are rules with seller credits and how much they can give. And that comes down to how much the down payment is and what type of occupancy. So if it's an investment property, you can only get 2% seller credits. If it's a primary residence, depending on your down payment, some allow up to 6% in seller credits. So I always, hope that buyers can get a little bit out of the seller, but of course it just depends. Whereas, a year ago, it was impossible to get any kind of seller concession just because we had so many offers, on specific properties.
Yeah, it's like I said in the intro here, things have definitely changed this fall from last fall, which is good. Finally, for people that have been waiting in the wings so long, I've been getting a lot of calls, and people are definitely, coming out of the woodwork now. There's still a demand up here, and there always is going to be.
Mm-hmm.
But it's finally nice that you can have a shot at some of these houses, and some of these people are getting more realistic with their pricing.
Mm-hmm.
So the ones that I was just looking, researching my video for Tuesday, I was looking at some of the houses on the market down in Kalispell, and it's funny, the ones that have been on the market for over 100 days, they're coming way down in price, but that when they listed it, they're like, well, my neighbor 2 years ago got this.
Yep.
So so the what was my question here? So if you were consulting a buyer right now, is it better to put, more money down, or, buy down the rate, or is that the same thing? Is there a difference, or what do you think?
It is or it isn't. I always ask the question, tell me about the property. Is it ready to move in? Are there things that you're going to need to do after you buy it? I'm a cash is king person. So I say, leverage yourself on the house, save money so that you can do those improvements in cash versus getting a home equity loan afterwards or using credit cards. Those tools, the home equity loan or credit cards are short-term tools to people to access funds. They're not long-term. I think some consumers are feeling the pain of that right now because that's the rate that's been changed so dramatically through the last, 20 months. And so I like clients getting into a fixed rate, saving their money, for those potential improvements. But as far as down payment, typically you'll see some rate savings on the 5% mark. So 25% down versus 20% down, you may see an eighth of a percent in savings. So it just really depends. Buying down the rate, again, is a one-time fee. And so if they're planning on having the mortgage for a long period of time, that may make sense. But as far as down payment goes, if you can avoid PMI with 20% down all day long, because PMI is just money to thin air. You never see it. It's literally there just so the bank will lend you, without 20% down. So
I'm kind of curious for everybody out there listening to Natalie, any of you guys that have a mortgage right now, wherever you may live, I'm curious if everyone, where everybody is right now, if you were one of the people that has one in the under 3%, right? Put a 1 in the comments. And if you're over, if you're at the local or the current things, put a 2 in the comment. I'm just curious to see how many people still have the good rates.
Yeah, and that's definitely a hot topic right now too. Do I sell my house because I have a 3% rate? Again, that's risk appetite. Are you okay turning your primary residence into a rental? Do you have access to money for a down payment on your next purchase? It's definitely a way to build wealth through real estate by converting your primary residence into an investment property. There's nothing that has to be done to your mortgage. You'll want to contact your insurance agent to make sure you have a renter's policy on there. But as far as the mortgage goes, there's nothing that you need to do if you've been in the loan for 12 months. And I am seeing people take advantage of that, because I don't know if we'll ever see 3% again, or 2.75, or any of those rates. I mean, the hope is that we get back into the 5s. But as far as those historic lows, I just don't know if we'll ever see it in our lifetime again.
Yeah. We have one guy, Dave, here from Boise.
Uh-huh.
Said he has the low rate. Let's see. We have a question from Richard here. I see a lot of places with much land but small homes near cities, cheaper than many other places in the state that are in neighborhoods or whatnot. What are the possible reasons for that? A lot of places with much land but small homes. I mean, there could be 100 different reasons for that. It's hard to say without seeing the exact property, but a lot of people, if you don't, it depends on the land. I've shown some lots lately that they're big pieces of land, but they have about a half acre to build on. The rest of it's the side of a mountain full of trees. And I mean, that's great. You can tell everybody, oh, I own 100 acres, but you can't do anything with it. It's on the side of a mountain. So that could be it. Again, I don't know, Richard. I'm sorry. There's just 100 reasons that could.
It may not have utilities either. We definitely see listings with off the grid properties, and those unfortunately don't fit a lot of the financing guidelines. So they're going to be considered land loans, which require a larger down payment. I know, Will, you've seen some properties like that.
Yeah, and this same Richard continued. I want to find a place that's quiet and has a good amount of land, but wants to use a VA loan. Is that doable? And isn't there rules on all of that with
Yeah.
VA?
Yep. So VA, you've definitely got to have a permanent source of electricity, as well as heat throughout the whole house. I have been successful with a cistern for water, but outhouses are not going to fly. We're going to need traditional plumbing. You would be surprised. There's quite a few cabins in Montana that, people want to buy and finance with VA, and unfortunately, it still has to fit within the box.
I have not had a VA buyer in a while, but
Mhm,
is it still, I'm guessing they haven't changed anything, but I know the biggest issues I've ever had with loans were VA loans, and it's because the appraiser would come out and there's so many, I don't know, they're just super strict. The house has to be basically brand new or they call things out. And then if the seller doesn't want to fix it, then you're kind of screwed.
mhm.
Has that changed at all?
It hasn't. One of the first things that I do when I'm writing a pre-approval or I've received a contract is I go pull the listing and go review it myself. Like I said, I've been doing this for 17 years, and obviously I'm not a VA appraiser, but if there's certain things that just don't look like it's going to fly, I'm waving that red flag up front. I've seen some really cool stuff go through VA. I've had some clients up in Eureka that had basically a house in a garage, like a garage. What do you call that? A shop? No, a shouse. A shouse, where it's a shop house, and like the living room door opened up. It was a living room garage door, and as soon as it opened up, it had views of the lake up there. It was gorgeous, but we just didn't know if the VA appraiser was going to have an issue with it. And as far as square footage goes, that's what they were looking for, and making sure that the property is safe and sound and meets all the requirements. And it worked out. It was great. I love VA financing because you can do 100% financing. And the only stickler is that appraisal. And, like I said, I'm not a VA appraiser, so I can't say yes or no, but I've had enough experience to look at it and say, there's no way this is going to fly, or I would be a little concerned about this. Something that comes up a lot is like peeling paint and rotten wood on log homes or cabins. Sometimes that gets called out and has to be replaced, or railings on deck. That's a pretty common thing as well, or railing on any kind of stairs in the house.
Yeah, it's all the safety stuff. One
Yep.
of the questions I always have and am never sure about, how about like a detached garage? Because I've seen a lot of nice houses, but then there's because they've totally redone the house and it's basically like new, but the detached garage is an old, kind of dilapidated, the roof needs to be replaced and it's, just garbage. And I never know if they're going to call that out or if they don't because it's not the living area, or if it's like you said, you never know.
You never know. Yep. If it's got peeling paint, it's likely going to get called out that you've got to do something with that. Even if the client, and I get this all the time, well, I'm going to tear it down as soon as I buy it. Unfortunately, it all has to be done prior to closing unless it's weather related. So roofs also get called out if it doesn't have a certain amount of age left in that roof, it is going to get called out, and it does have to be replaced or repaired prior to closing. So, yeah, unfortunately, there's benefits with that program, but there's also stipulations of making sure that the property fits within their parameters.
Well, and that's what always just annoys me because I mean, those should be the easiest loans of all,
Yeah,
if they're truly wanting to help veterans, which they should. Um, but they're the worst. I mean, I
they're
don't know.
difficult. Yeah.
Yeah. Here's another question from Phil. Curious what your thoughts are on the properties on the north end of Whitefish on the lake and the channel. How are the roads to town? Seems like it's a lot quieter and bigger properties, more privacy. Um, yeah, the biggest thing down there is the road. Um, I'm guessing you've been all the way to that end of the lake, Natalie.
Hmm. Yep.
I wouldn't want to drive that all winter long, I can tell you that. That road is not great. It's
No.
narrow. I know in the winter we get, some of the melting and thawing, and you get rocks and gravel fallen on it and just icy, and it's a narrow road, and that's always kind of been the issue. It is definitely quieter down there because of that road.
Mm-hmm.
And the properties, yeah, I guess they are bigger down at that end, but um, also more expensive because of that.
Yep.
So this is one of your old clients, Tom.
Oh.
Natalie helped us with our loan for our home in Missoula. We are a 2. Or they don't have the Natalie. You should have got them a better rate. We are waiting for the interest to drop so we can refinance. We will be calling Natalie. She's the best. I agree.
Oh, thanks, Tom. I hope you guys got to enjoy your house in Missoula this summer.
All right. Then we got Dave. How common is it for buyers to pull equity out of their current house while it is for sale to make a down payment on the house they're interested in purchasing?
If you have the ability, absolutely. We still count that debt against you. That's one of the ways that people are absolutely making the next move. Other, avenues for down payment. I've seen clients take distributions from IRAs, borrow against 401ks, get gifts from family members. So lots of creative ways to get access for a down payment. But if you can get a home equity loan on the house that you're eventually going to sell, that is absolutely a valid option. One of the things that I am seeing with banks is they won't do home equity loans on properties that are listed. So if that is your strategy, try to get the home equity loan before you list the property that you're going to use for collateral.
That is a very good tip. So here's a question. This may be a dumb question, but when you go in to apply for a loan or talk to you, it makes what you're, how should I word this? So is what you're buying going to affect the interest rate, or is that all about your credit and the current rate?
It actually is. So what you're buying is important because condos are heavily scrutinized on rate, as well as multiple units. So if you're buying a fourplex or a twoplex, those come into consideration for the rate, as well as down payment and credit score. Those are the main factors that we look at. So, we try to get a gauge of what it is that you're trying to accomplish so that we can show you what rates are at that time. There are options where you can lock rates ahead of finding the property. I don't like that option. The reason for that is sometimes there's non-refundable upfront cost associated with that. And, depending on the market, it may take, 3 to 6 months to find what you're looking for. And we don't know, rates may come down in that time frame. So that's definitely a conversation that comes up a lot right now.
All right. And then we got Gordon up in Eureka. Hello, Gordon. Here's another question from Richard. Besides VA, what are other sorts of loans that do 100% financing? Only other one I know of is an agricultural loan I heard of in South Carolina.
Yeah, so there's a USDA loan. That's probably what he's referring to, also known as rural development. Rural development is eligible in most of Montana, if not all of Montana. In other states, it's in selected areas, and it does allow for 100% financing. The caveat with that is that you have to fit within a certain income guideline for that. So there are income caps on that, as well as purchase price caps. They're a little more strict on credit history as well as debt to income ratios. We do have other down payment assistance programs through Montana Board of Housing that could gap that bridge between the 3.5% down on an FHA loan. So there's a variety of options. The higher the loan amount, the lesser chance of that happening. So if you find $1 million property and you want to finance it 100%, unless it's VA, it's not It's not a thing.
I just thought of something while you were talking that
Yeah.
kind of goes along with this. So I didn't realize this, but a lot of people think that once they talk to you and you say, yeah, you're approved for whatever, and then we go ahead and make the offer. Um, and then they decide, oh, well, with my new cool property out in the country with all this acreage, I'm going to buy a big pickup to run around on it. And you told me one time that, again, something I did not know, that right before closing, the day before, whatever, you guys run another credit check. How does
It
that work?
depends. It depends. I always tell people to be prepared for that. It can also be pulled after closing to make sure that the lender didn't falsify anything in the file. And so, you sign a loan application at closing stating that all of your debts are relatively the same. You haven't opened any new credit. So technically, if you open new credit during that time frame of application to closing, you do need to disclose that to the lender and you do have to qualify with it.
Yeah, luckily I've never had that, but I've heard all kinds of stories of deals just blowing
Oh,
up
yeah.
at the end because somebody went and bought a truck or
Or another
whatever.
property.
Yeah, exactly. Um, so yeah, do you have any other like crazy stories like that you've dealt with in all of your years?
Oh, I have had many wild scenarios, but the biggest thing is like changing jobs. That also should be disclosed to the lender. If you're changing jobs in the middle of the transaction, we got to know about it. Right now, we still have a verification of employment that's done right before funding. So in that last week, it's a random time frame. It's not even like 24 hours or 5 days. It's just whenever it fits in the process. There's a verbal verification for people that are W-2 workers to make sure that you're still working there. And I did have a client that we got through the whole process and she just totally spaced that she was changing and starting a new job 3 days prior to closing. So I got a wild phone call from my processor saying, "Oh my gosh, they're not working anymore. I don't think they qualify without this income." So luckily, the client had already received a new job and a new pay, and we just had to get all of that documented in the file and get it back to the underwriter. Thankfully, we had a couple days to make those adjustments and requalify with that income. But
Yeah. So there's a lot of people out there that watch this that want to move here, and I
mhm.
get this question a lot when you're not on. Uh, so, and it goes along with the job thing you were just talking about. So, if you're living in Oklahoma, for some reason have a lot of Oklahoma people that usually watch, and you want to move up here, and you talk to me about the. I know that it depends on like if you're doing the same type of work, like if you're a plumber in Oklahoma and then you move over here, but it's a problem if you're a plumber and then you decide to become a welder. I mean, I don't know,
Yeah.
but how does that all work for somebody
Depends
moving in
on the
here?
situation. The hardest scenario is when someone's self-employed and moving. If you're self-employed and you're moving from one state to another, or even the same state and moving from one town to another, we really have to justify that your income's going to stay the same. Because with self-employed borrowers, we're looking at the last 2 years of tax returns or the last year of tax returns. And you're basically starting over if you're moving from one state to the other. So likely, self-employed borrowers that are moving from Oklahoma to Montana, we're not going to be able to use that income until you're established. It's a little different if it's W-2 wages. So you can actually move without starting that new job in most programs. So we just need to see the job offer and we can look at and make sure that it's the same line of work. Sometimes if you're switching careers completely, the underwriter does want to see that you've started that job and that you're not just getting a job to qualify to buy a house. Um, whether that's a month, 2 months, 6 months, it's kind of an underwriter discretion. And then, of course, the program that you're, pre-approving for or receiving.
Yeah, that again, I'll say it again. I said it at the beginning. I put all of Natalie's contact information in the notes of the video. So feel free to reach out. I put her email, her cell phone, and her website where you can apply for a loan right through there. But yeah, she's awesome and can answer all of these things. Let's look at what else we have here. Joe from Pennsylvania. How about my Nittany Lions? They're 2-0, Joe. I'm pre-approved for 230 as a first-time buyer. Can't find anything even close to that, especially not that can house 2 adults and 2 children. Yeah, that's a tough.
It is a tough
4 years too late. Yeah, I mean the prices are coming down a little bit, but that's going to be a tough one. And that's the other thing that kind of goes along with this that is unfortunate is that the people that have been approved, like the first-time home buyers for RD loans or whatever, the houses that are in this price range, they
don't qualify for the program, right?
Exactly. What we were talking about earlier, the appraiser is going to go there and say, nope, nope, nope. These are all things that need to be fixed. And I try to say this in my videos over and over again. This is why you need a good agent when you're looking at houses, because I mean, you just think, oh, well, whatever, so I don't get the house. Well, if you don't know any better and you make an offer on a house, then you pay the $400 ish for an inspection, which everybody should do an inspection. Yeah. Then what are appraisals now? 800 to 1,000?
Yeah, depending on the area.
All right, so now you're $1,400 into this house that, had you been with myself or a good agent that would point these things out, you're not going to lose that $1,400 because unfortunately, once you do the appraisal, and if they call out a bunch of things and the seller says, sorry, I'm not fixing that, you don't get your money back for the appraisal.
Nope.
So that's the thing you really need to be careful of and know. And that's why I always ask people, if they're working with Natalie or whomever, what type of loan they're using, because that's going to be huge in what type of houses we should even bother looking at. Because again, the government loans, the RDs, the VAs, the FHA, they're fairly strict. Some are stricter than others, and they're going to call out all these little things. And again, if the seller doesn't want to do it, then too bad. And like Natalie said earlier, you can't say, oh, well, I'll fix that after closing.
Yeah.
And you don't want to make repairs to a house or pay for repairs to a house that you don't own yet. So
that does happen though.
Yeah, but it's kind of a gamble.
Financing is solid. Making repairs on a house you don't own yet, it's pretty risky.
It is a big gamble. Here's another question from Dave. Are there times or situations when easements for driveways would not transfer to the new buyer? No, because easements are recorded and that would show up on the title report if they went and tried to get rid of that easement. And the title policy make sure that you can access. I'm guessing you're wondering if all of a sudden you can't get to your lot. Well, that would show up on the title report, and that would not happen. So there's bigger things to worry about than that one. And then Terry, thanks for recommending Natalie. She made our purchase smooth. Terry's a fairly new homeowner now. It's been about a month, I think. So, and Richard, again, speaking of income, how is the job market in Montana? The job market here is still good. It's the hard part is finding a place to live.
Yep.
So If anyone else has any type of questions about this, we're coming up on about 15 minutes to go. So get your questions now so Natalie can answer them. But I guess back to the rate thing and the credit, how big, I guess, what is how do I word this? What, like, obviously the higher your credit score, the better for your interest rate, but is there like a point of no return where it doesn't, if you're
Yeah,
too,
yeah. Right now, I would say if you're under a 680, we need to see if there's a way we can manipulate your scores in a short period of time to get you above 680. For whatever reason, the rates for someone that has credit under that benchmark, it beats up the rate. And when I say beats up the rate, you're paying not only higher rate, but you're paying higher fees. And so there are tools that I have with the credit agencies that will let me simulate what it will take to increase your score above a certain amount. And if it's not accomplishable, it'll say there's no chance in that. Um, and I would say 9 times out of 10, as long as they follow those instructions, we get the credit score repaired. I wouldn't say repaired, rescored in a short period of time, meaning a week from submitting that documentation. And then the pricing for that rate will be better. So the
so,
sooner that you can start working with a lender and going through the pre-approval process and then see if there's opportunity to increase your scores, we can also do it during the process. So once you go under contract, but some of the main factors that I see where we can manipulate that score higher is if your credit cards are almost maxed out and it's just the timing of when you make your payment versus when they report to the bureau. I use my American Express like it's going out of style because I want the points. But God forbid someone pulls my credit on a certain date, like it's not going to be pretty because really use it for everything so that I get Sky Miles and then I pay it off every month. So if someone looks at that and they're like, wow, she's using a lot of the, credit that's available to her, it's not a positive thing on your credit score. So we can show you've paid down the credit card and submit that. And then they do a rapid rescore is what it's called. And then we get that credit score up, which is pretty cool. We don't have to wait, 60 days.
what's the highest you've seen it come up in that short of time?
Oh, I've seen it go up over 100 points.
100 points?
Yeah, it just depends on what's on the credit report and what it is going to take to get it there. So if, I've got a client that's got 5 credit cards and all 5 of them have 80% of the limit, outstanding, and then we reduce those to 0 or 5% or whatever the little tool tells us, it's pretty cool. It's a really neat tool, but I only use it when, we're almost near a benchmark. And like I said, for whatever reason, 680 is typically that where we really see a price shift on the rate. There are times where I can't do anything, and I'll be totally upfront and honest about that. If you're in the 4s or the 5s, mid to low 5s, there's not going to be a lot that I can do. I'm going to be referring you to a credit repair.
We seem to have lost Natalie. Hopefully she'll be back here soon. All right. Well, as we wait for her to come back, let me go to some other questions here. Gordon, know a couple building a 2-story home nearby. They have been told septic permit may take 18 months due to state inspections. Well, cost quote of 200 foot. Is this for real? I don't know on the well that I have not dealt with anybody doing a well lately, so I'm not sure what they're charging, but I would definitely get other bids. And the septic permit, that's kind of weird too, that they told them it'd be that long. I have not heard of that. You're up in Lincoln County. If you're in Eureka, maybe it's a Lincoln County thing, which is even more surprising. I wouldn't think they would be. I would think we would be longer down here, and I haven't heard it being that much down here. So, yeah, I don't know on that. So, anybody else? We are coming up on an hour, and Natalie, we've lost. So, if anybody else has any questions, fire away. We'll wait here for a minute, see if she can get back on. She was right in the middle of a good story. But again, if you guys have any other questions, I put all of her info in the notes of the video, and she can answer any of your lending questions. Let's see, Richard, best place to golf. Where exactly are you looking? There's a course up in Eureka called the Wilderness Club that's really good. There's a place in Whitefish, Iron Horse. It's really good. There's a lot of good courses around here. So, Dave, any news on that lake development you talked about earlier this year? I have not heard what's going on with that. I heard that it might be done. I'm not sure. That's been pretty quiet. So it looks like we might have Natalie back. Can you hear me?
Yes. So sorry. My computer evidently doesn't have enough battery power for Sundays.
You were right in the middle of your credit score talk.
Yeah. So if you're in that 400 to low 500 range, mid 500s, typically I'll refer them to a credit repair company. They have more resources and they're more dialed in on what it is that needs to be cleaned up to get those scores up.
I'm kind of stunned that you could get it up 100 points in a week. That's a big.
It depends on what's on the credit report.
So, like, I guess what I was getting at earlier with the question is, if you're already at 680, is there a huge difference between 680 and 725 in your rate, or not really?
Yeah, absolutely. It could be an eighth of a point. It could be the cost of the rate might be, 50 basis points. So that's 0.5% of the rate. As soon as you dip below 680 or 720, it's kind of by 680, 720, 740, 780. Once you're at 780 or above, they're all considered A+ at that point. So those that are like, oh my gosh, I'm a 792, I need to have an 815. Well, actually, no, you don't. The pricing is the same at 780.
Well, here's another question for you. So when everybody reads the paper in the morning and they look at the rate that they put in the newspaper, is that for the people with the 780 score?
Yes. So if you read the fine print, typically it's primary residence, 30 to 25% down with 780 plus FICO scores and low debt to income ratios, which doesn't typically line up with the average buyer right now.
So how much high, like, I nobody's going to hold you to this, but like how far off is it if you're the normal guy with a 680 credit score that, doesn't have a whole bunch
it could be a quarter. It could be a 0.25% difference in rate.
Huh.
Yeah.
Well, there you go. Dave, what was the rate on Friday? Can you answer that?
Oh, let me pull out my my phone and my calculator. Based
remember, Dave, this is if you have
assumptions, right? So one of the tools that I like using is it's called Mortgage News Daily. And what they do is they survey different lenders countrywide and they pull an average. And typically my pricing is right in line with what they post. But again, they use a synopsis of 25% down primary residence, blah blah blah. So they they said on Friday the 30-year fix was at 7.22. I believe I locked a rate Friday at 6.99. So I'm typically in that range, and that is spending a full point to buy down the rate. And that again is typically in that fine print when you see rates posted.
All right. And then Bob has a question. Natalie, can you roughly touch on construction loans into permanent loan rates on a small home and land that is already paid for?
So I don't do construction loans, but I have experience in construction loans. So when I started my career, I started at a community bank here locally. I worked there for 10 years. I did consumer lending, construction lending, land, and real estate. So I am familiar with the product of a construction loan. And I have some really great bankers that I work with for clients like yourself that need the tool to get from land to a house to permanent financing. And there's a couple different products out there. One specifically is Glacier Bank. I believe First Interstate has it as well, where it's a one-time close. And so it's a construction loan built on the proposed final construction, the final product value. And it's drawn off of throughout the process of building the house. So it's, let's say you need $500,000. You're only going to pay interest on the amount that is currently drawn on that loan. So as construction progresses, your payment is also going to get a little bit higher, and those are typically interest only payments until you've reached the completion of the house. Those one-time construction products will automatically convert into a long-term fixed rate. The second type of loan is a construction loan, and it's got a maturity on it, like a 12-month or an 18-month, depending on how long the project's going to take. And it's the same thing. It's going to get advanced throughout the process of building. And then once you're completed and it's fully maxed out, you can refinance that loan into a long-term fixed product. I don't like refinancing or locking in that rate until we're about 45 days out from completion, because you know what happens at the end. The cabinets are late or the countertops haven't showed up. Something's always behind. And when you lock in a rate, typically you have to close within that lock time. Otherwise, there's penalties per day that you're not closed. And you do pay a whole nother set of fees associated with that refinance. So the benefit of the one-time product that, like I said, some of our local banks use is you pay one set of fees, whereas the other is a two-step process. So you're getting a construction loan, and then you're able to refinance into current rates at that time.
All right. Dave says you're a great guest.
Awesome.
Well, and that will bring us to the end here. Thanks everybody for tuning in. And again, I put all of Natalie's contact information. If you joined us late, you should go back and watch the whole thing. She gave all kinds of good info. But if there was something we didn't cover and or questions you may have about loans up here, give her a call or an email.
Yeah.
Or go to her website. So thanks again. We'll see you guys in 2 weeks.
Thanks, Will, for having me.